Hello everyone, welcome back to the channel. So in today's episode, I'll be delving deeper into whether or not you should be owning Google as well as Meta shares. So I own both companies. Google is currently around 11% of my entire portfolio. Meta is closer to around 5%. So I'll be delving into the upside case, the downside case for both companies over here. So let's talk about Google first. My recommendation for Google is a hold. So for Google next year, you have multiple different upside scenarios here. So for example, you have Anthropic as well as SpaceX IPO, which will artificially inflate Google's earnings even more. So last year, there were many instances where Google beat the Wall Street estimates by quite a fair margin. It was because they had some investment gains in there. If you remove some of the investment gains, there were actually instances where they missed Wall Street estimates. So this year, with Anthropic and SpaceX projected to IPO, Google will have to realize all those gains, and when they realize all those gains, the EPS will be inflated as well. Second of all is Gemini's continued innovation and share gains away from OpenAI. So over the past 12 months, we've continually seen Gemini taking away share from OpenAI. So with Google's current talent team, with their current AI talent team, if they're able to do so, Google will remain as this AI winner. And this AI winner narrative will allow it to command a higher multiple than all of its peers. However, there are potential downside scenarios for Google in the long term. So let me try and cover this one. Gemini new ads could be margin dilutive. There were rumors last year that Gemini is going down the route of providing ads as well, because that's the only possible way outside of a subscription business model whereby Gemini is able to monetize itself. So Gemini ads will be a new ad tier on its own. It's a new ad placement. So for example, on Google, you have your barriers. On YouTube, you have your search. You have display on YouTube as well. Gemini will be another category of ads. And for advertisers, they use something called Performance Max on Google, giving Google the complete control. So what that means is companies can either opt in or opt out of Gemini ads in the future, but Google will ultimately be the one that deem whether or not the ad campaign is suitable for Gemini. So they have complete control on whether or not they're able to place the ads on Gemini. So this is the scenario over here. This is what Gemini is facing as well. Gemini is unprofitable. So Gemini ads will be margin dilutive, but given Gemini's cash burning nature today, an additional stream of income and a potential increase in terms of ad inventory is a positive for now. But in the future, when Gemini becomes completely profitable, this could be a drag in terms of margins for the firm. So as you can see over here, the cost per query for a traditional Google search is a lot lower as compared to an AI query. So this is ChatGPT's cost per query. It is a lot higher than Google search. That's one portion. So AI chatbots now cost much more than Google search. The key metric to look out for is whether or not Google search market share is going down. So currently now, Google search is maintaining its market share. So what that means is that the company is still able to defend its high margin empire in Google search. But if in the future, we see a rotation from Google search into, let's say, Gemini, for example, that is actually a negative for the company, because if Google search starts to drop in terms of market share, so let's say some of the traffic goes to Gemini, it's not exactly margin accretive for the company because Gemini is a lot more capital intensive as compared to a traditional Google search. However, there is a positive in terms of this Gemini ads over here. So a potential total addressable market unlocking for Google is as such. Google's informational searchers, they make up around 50 to 80% of total searchers. So what that means is these searchers, they are zero revenue searchers. It's basically you asking for, let's say, what is Google? What is Gemini? Yeah, those searchers. So those searchers are not exactly profitable. So concurrently, your AI searchers, they are normally informational searchers. So what that means is your chatbots are normally when you ask questions, when you ask informative stuff, those are currently not monetizable, not so monetizable on Google. So the thesis over here is as such, Google might be able to turn these informational searches into extra revenue for the firm. If Gemini is able to put ads on the app, besides all these informational searchers, if they're able to have a conversation with you, if you have a conversation with the Gemini chatbot and then eventually it turns into a commercial conversation, that could be a potential revenue stream for Google. So the second thesis for Gemini right now is the total addressable market expansion in terms of agentic searches. So for example, right now, if let's say you want to plan a holiday, if there's no chatbot, what you will do is you'll go on Google and then you'll search for multiple different places, search for 50 plus places, and then you try and get a good hotel from there. But currently now, if you're able to do it on a chatbot, and if a chatbot is able to convert you at a much higher rate, which is what Gemini could potentially do, this could unlock a potential market for Google, basically allow them to delve into agentic searches outside of their traditional Google search arm. So further upside for Gemini includes TPU as well. So there was the TPU narrative that was coming up just a few months ago, where they were saying that TPUs were replacing GPUs. Not quite, only in Google's company, of course. So TPUs now lower cost per query by up to 70% in Google only. And Gemini's cost per query is significantly lower than OpenAI. So OpenAI is still using NVIDIA GPUs. Google Gemini is using the TPUs. So Gemini transition from margin dilutive to net profit accretive could come very soon. But the bet will be dependent on Gemini's ability to provide higher conversions through a 10-minute conversation on an AI chatbot. So this is the formula over here. This is revenue per query equals to ad load. Ad load means how much ads they can put to a consumer, times your click-through rate, times your cost per click. So your click-through rate will likely be higher for the AI chatbot. Your cost per click, which is your CPC, will also be higher for your AI chatbot because they're higher converting. The problem is this number over here, which is the ad load. We don't know how much ad load Gemini is able to provide. If the ad load is significantly lower than Google traditional search, then your revenue per query will be lower for your Gemini, of course. So that's the problem with Gemini right now. The ad will likely be a lot lower than traditional search because you're normally asking questions, you're normally learning on there. So there could be room for margin decline over time in the long run. But for now, it is positive in the short term. Long-term profitability depends on Google sustaining its search market share, so that is an important metric to look out for. AI inference cost lowering, which is through TPUs, and structurally increasing revenue per query. So this number over here, increasing the ad load or increasing the cost per click. So overall for Google, my summary is as such. I'm planning to hold on to the company, but if a compelling opportunity comes in the market, I will likely trim down my Google position to switch over to the other firm. The company is trading at a 30 times EV to EBIT. So for example, Meta is trading at 20 times. You have Microsoft trading at 26 times, you have Amazon trading at 33 times. So Google is not exactly cheap at today's price, and the potential long-term runway for the company could be in question if the company continually dilutes its margins because of this AI chatbot portion. Next company that I'll be covering is Meta. So for Meta, my recommendation for the firm is a buy. In the case for Meta, there are multiple different upside scenarios. So first of all, it's a full AI ad build out. Second of all is the potential monetizable streams for the company. Third is the undervaluation. And last of all is the protection in terms of downside for capex overspend. In the case of the downside scenarios, first of all, it's excessive capex spend. Second of all is irresponsible spending by management on talent. Last of all is overcapacity concerns. So I'll be covering the upside scenario first. So if you didn't know what Meta is doing with their capex, what they're doing with their capex today is pouring it into this thing called your Advantage. So Advantage Plus allows advertisers to basically create ads on Meta through images using their LLM. So for example, if you're an advertiser, let's say you want to go on Meta and then you want to place an ad for your e-commerce store. All you will need to do is to go and place an image on there, and then the AI will generate an ad for you that you will be able to post directly. So of course, there's the option of you manually putting your ads in there also, but the cost per click, as Meta says, will likely be higher. So currently, Meta's primary audience are the small businesses in the US. For example, around 90% of advertisers on Meta, they are from small businesses. Small businesses, they generally lack the ability to create better creatives. So this could create greater stickiness for them. So results have shown 9 to 12% reduction in terms of the cost per action. So this will further lower the barriers to entry for e-commerce stores online trying to publicize the ads and drive volumes as well as incremental revenue for Meta. And this is Meta's way of directly monetizing their AI spend in these LLMs, unlike some of the other AI companies. So a lot of the other AI companies, they're creating the LLMs for potential use in the future. In the case of Meta, they're already directly monetizing it. So that's the first upside scenario. Second upside scenario is the untapped revenue streams that the company has. So if you didn't know, for example, Rails was actually unprofitable just a few years back. And then currently now, it's a 50 billion run rate business, if I'm not wrong. So I think they 25x the company's run rate in terms of Reels in a couple of years. So currently has WhatsApp as well as Threads. WhatsApp is relatively untapped, Threads as well. Threads, I believe, has 250 million monthly active users. WhatsApp thesis is extremely simple. So there's a metric called average revenue per user. Basically, it's the revenue from this portion of the business, which is WhatsApp, divided by the number of users on the app. WhatsApp is extremely popular in the Middle East, in Europe, as well as in Asia. So in the case of WhatsApp, they have a relatively low average revenue per user as compared to your other platforms, like for example, Telegram, like for example, Line, as well as WeChat. Second of all is that WhatsApp has a sizable user base, which is similar to Line as well as WeChat. So in the case of Line and WeChat, they have extremely high average revenue per user because they include all the other platforms into the app itself, creating an entire ecosystem. That is what WhatsApp will potentially do in the future as well. And this is a relatively untapped revenue stream for the firm, similar to Reels. So the company has proven that it's able to drive Reels from an unprofitable to an extremely profitable business. In the case of WhatsApp, this could be an upside scenario for the firm as well. Moving on, so the third scenario is because of the undervaluation of the firm. So currently now, Meta is trading at a 20 times EV to EBIT. Google is 30 times, Amazon is 33 times, Microsoft is 26 times. On a relative EV to EBIT comparison, Meta is currently the cheapest Mac 7 company. Last one is this thing called GPU fungibility. So GPU fungibility refers to the ability for the company to divert its GPUs from one usage directly to another usage. In the case of Meta, currently their GPUs are used for two cases. Number one is for recommendations, to drive recommendations on the app. Second of all is their generative AI portion. So if generative AI portion experiences overcapacity, you can simply switch it over to the other side. And second of all, management has said that it is not worried about overbuilding. And the worst case scenario is the company will have to basically start selling something called APIs. So the LLM is the brain. If you sell APIs, you are allowing an external company to rent the LLM's brain. Llama 5 is a closed source model. Closed source meaning you can't use the brain for free. So I'll be covering this later on, but Meta is going down the stream of selling their APIs, which is not really a positive. So in the case of GPU fungibility, basically it's a hedge against overcapacity. In the case of the downside scenarios, first of all, it's just excessive capex spend. So Meta's capex to revenue ratio is the highest right now, 37% as compared to Google as well as Microsoft, which is around 23%. If you increase your capex, what happens is your depreciation and amortization will also increase. And when your D&A increase, then of course your net profit will be hurt in the future. Margins will start to fall down. So a key metric to look out for is whether or not D&A is growing faster than revenue. And in the case of Meta today, it is creeping up. Second of all is irresponsible spending by the management team. So they're issuing out high stock-based comp, which will hurt the bottom line. They're increasing compensation with their new hires last year. So this year they said G&A expenses will increase by 22% because they hired a lot of talent last year. That wasn't a positive. That was why the stock went down by, I believe, around 15% last year. Last one is this thing over here. So just now I talked about your APIs. API is renting the brain of the LLM. So management has previously said that when your overcapacity comes, the company will try and monetize through APIs. And what Meta is doing today is they're trying to build for overcapacity. They're trying to build for peak cycle demand. And most of the times, the demand is not at peak cycle. So what that means is there'll be a gap between the demand as well as the peak cycle demand, because most times will not be peak demand. And because Meta is trying to build towards that, there will be overcapacity. And we're seeing signals of overcapacity already. So Meta, for example, is trying to monetize through APIs for this new LLM that they're creating, which is Llama 5. So that suggests overcapacity, one thing to look out for, especially with their continued acceleration of capex. If Llama 5's performance is not up there with Gemini as well as OpenAI, API usage will fall and overcapacity costs will not close. So the key metric to look out for will be their pricing in terms of their APIs. Are they trying to undersell? As well as the performance of the LLM relative to OpenAI's as well as Google's LLM. So short summary for Meta. So number one, the short-term story will be dependent on Llama 5's performance. They need to be the best at everything, which is something called state of the art in terms of AI. Second of all is the long-term performance will be dependent on their total addressable market expansion as well as WhatsApp monetization. In the case of Meta, I think the long-term runway is incredible for the firm But short term, we could see some headwinds if Llama 5 disappoints. So watch out for Llama 5's performance to track ROI on the company as well as the spending. Two things to look out for, latency as well as the LLM leaderboards. So overall, my assessment for Meta is this. I think the company is the cheapest Mac 7 company. It is cheap because the markets don't like the AI story for the firm. They think that Meta's AI spend is used for nothing because they don't have a cloud service. But they're actually monetizing their AI quite well. They're doing quite well in terms of their ads division. They're funneling all the money into improving the ads ecosystem. I think the markets are misunderstanding Meta, and that's why the company is trading at such a cheap valuation today, which is why I have this buy recommendation. It's currently around 5% of my entire portfolio, but there's variance with Meta. So there's either an extremely bullish case an extremely bearish case. That's the problem because the company is spending all this money. So long story short, I'm looking at Meta, I'm tracking this. If the company goes to a cheap enough valuation again, similar to my average price, which is currently around $600 a share, I'll look to enter. And yeah, that's all for today's episode. Hopefully you guys learned something and I'll see you guys soon.